Hi there, Howard Friend here. This is the third in a series of webinars I'm doing for clients, customers of CFI on technical analysis and trading topics. So this is all about momentum oscillators, and I'll be showing you how they can be used to gauge whether a market has gone too far too fast and is ready for a pullback, and also perhaps some good entry points for trading in the direction of a trend. So, first slide. So, first, indicators, oscillators are basically they are indicators which they swing from extreme high and low levels. So they're really a cyclical indicator, and they're there to give you an idea that the market is basically is ripe for a pullback. So if we're looking for the market to come back to mean revert, then the oscillator is the tool of choice. So we're looking to see whether a market has become overextended and is ripe for a reversal. So oscillators, they look for or they detect a loss of momentum. So, for example, if the price is moving in one particular direction and the momentum oscillator starts to slow down and not confirm the move, then that gives you a pretty good indication that the move is perhaps in its latter stages, and there's a potential price reversal about to occur. So, oscillators, unlike trend-following indicators, which we covered last time around, they are more leading indicators. So they're more, in some ways, predictive, whereas trend-following indicators are more lagging, and they tell you where the price has been, and they give you some indication of the trend's direction. Whereas oscillators are much more cyclical, and they they give you early warning of an impending turn in price trend. So if you're looking to catch a turn in trend, then the oscillator is the kind of tool that you should be using. So the theory is that as the price moves in its trend, it zigzags along and makes higher highs and higher lows in an uptrend. And as the trend starts to mature, we start to see a loss of momentum in the price. So what will happen is the trend will move to new highs, but the oscillator will tend to not move to new highs, and that will give you the divergence, which indicates a loss of momentum, which warns about a potential turn in price. So you can imagine if you throw a ball up into the air, and gravity starts to pull it down. So as the ball is ascending, you'll see a loss of momentum. In other words, as the ball kind of goes higher and higher into the air, it's still rising, but the speed of ascent is slowing down, and that's the kind of principle that we use here with the momentum indicator. So basically, the price is rising, but it rises at a slower and slower rate until eventually gravity kicks in, and then the price starts to reverse. So momentum oscillators are derivatives of the price. They're not as important as the price. The most important thing that a technician has a tool at his or her disposal is the price chart. So the oscillator is a derivative of the price chart, but it's an important piece of evidence which should be read alongside the price chart. So the oscillators are usually placed below the price chart and is used as a supporting tool. So some traders who follow markets based on market cycles, people believe that markets move in cycles. The oscillator is quite a good tool for detecting when a market cycle should turn. For example, when you plot an oscillator alongside a price chart, you'll notice that the troughs in the oscillator will occur with troughs in the price chart itself. So it's quite a good tool if you are a cycle or a cyclic analyst and looking to see when a market is about to turn in trend. Okay, let's take a look at how the oscillators typically move along with the price. So here's a sort of rough kind of sine wave idea about how the oscillator typically works. as I say, they oscillate, they swing from overbought to oversold and back again. So you have this kind of cyclical motion here where the market goes higher, trends higher, the oscillator goes into an overbought zone, then the market tops out, and then you start to see a big turn down in momentum, and then the price comes down and the momentum indicator goes down with the price until you get to the oversold region, and then the market bases out and then starts to go higher, and so on and so forth. So you get this kind of swing between extremes of overbought and oversold as time goes on. Now, in an uptrend, what you'll tend to find is the overbought levels get higher and higher, and the oversold levels get higher and higher. So most momentum oscillators typically will have a predefined range. So, for example, if you're looking at the RSI, the default setting is between 30 and 70 to denote overbought and oversold. But what happens in a bull market is these levels get shifted higher. So the RSI may be topping out around 80 or 85 and basing out around maybe 40 or 45, depending on how strong the trend is. And in a downtrend, you'll see a similar kind of shift where the oversold levels get progressively lower and the overbought levels also get progressively lower. So you may find a situation where the oversold levels, the oscillator bases around maybe 20 or 25, when normally it would base out around 30 for an RSI and top out perhaps at 60 or 55 for the RSI. Okay, so how do we use oscillators? Well, the main uses of oscillators are to identify extreme zones where the market typically reverses. In other words, regions where the market has been historically overbought and oversold. These values are important because they can give us a framework to enter or even exit a trade based on the historical, the nature of the market, how far it gets beyond its previous values. So what we're looking for is a divergence with the price, as I mentioned before. As the price moves higher into new high territory, the oscillator goes along with it to a certain extent. And then when we get to a certain point when the market trend matures, the oscillator does not follow the market into new trend highs. We can also use oscillators to identify a trend. So we're talking mainly today about overbought and oversold extremes and mean reversion type trades, but you can also use an oscillator to give you a gauge as to which way the trend is. For example, you can use the zero line in some of the oscillators, for example, the moving average convergent divergence, the MACD, or momentum, or even rate of change. You can use the zero line or the neutral value to give you an indication of the trend. Some oscillators have fixed limits where they trade between, for example, levels of 0 and 100. And this would be the case in point for RSI, Relative Strength Index, and Stochastics, both of which we'll cover a bit later. Whereas there are a group of oscillators which do not have limits. For example, momentum and rate of change, also a couple of indicators that we will cover a bit later. So you have two kind of main categories of indicators which are based on whether they have what I like to call artificial limits to the upside and the downside or not. When you have these no limit oscillators, it's good to use visual inspection to give you a gauge on whether the oscillator is overbought or oversold. So let's see some examples of oscillators in action. Okay, the first one here is I've got a daily chart of gold futures, and we're looking at the RSI, the Relative Strength Index, using its default period, or one of its default periods of 9 period. So it's basically a 9-day RSI. Now the theory is that the RSI should top out not too far above 70, which is the overbought level, and base out not too far below 30, which is the oversold level. And you can see on this particular chart here that the oscillator, for the most part, swings between levels of 30 and 70. Every so often, it'll poke above or below these the thresholds, and that often gives you an indication that the market is perhaps ready to make a turn in trend, whether it's for a major trend or whether it's for a minor correction against the trend. But certainly some value can be had by using these overbought and oversold levels on the oscillator. Next example, this is a chart of euro dollar, a 30-minute chart of euro dollar with that same 9-period RSI, again with 30 and 70 as overbought and oversold. This time around, I've ringed the overbought and oversold movements into overbought and oversold territory, and how they kind of coincide in some respects with some of the highs and lows on the chart. Now, oscillators, they have a lot more value when the market is in a sideways pattern. In other words, when the market is not so much in a trend, it's more in a range, that's when these oscillators can really come into their own. And as we know, there are very long periods when markets do spend time in trading ranges. And that's where the oscillator can help you determine whether a market is naturally overbought or oversold. So in this case here, we can see a few examples here where the market breaks into oversold territory and bounces or stops falling in a downtrend. Here, the market breaks down 108.20 or so on euro dollar. The oscillator goes briefly below the 30 level, turns up back through it, and then we see a nice bounce in euro dollar. A couple more examples here. So they may be good for catching 30 or 40 pips on this particular chart. Next example, this is Australian dollar, US, Aussie dollar, 30-minute, again with the 9-period RSI. And also I've put in the slow stochastic oscillator as well, both of which we'll take a closer look at a bit later on. What I've done is I've ringed, again, the highs and lows, where the market has broken into new high territory and the oscillator has gone into overbought or oversold territory, and then come back into the neutral zone. That's typically when we get the signal to take a trade against the trend. So the market goes higher, tops out, goes into overbought, and then starts to trend lower, and the oscillator comes back from overbought into neutral, and that gives you a signal to sell the market for a certain number of bars. Another example here, this is dollar Canada on a weekly chart. And this time just plotted alongside its stochastic indicator, 14-period, 3 and 3. So the stochastic indicator here, you can see I've circled in red some important highs and lows on a weekly basis. So let's say you're a multi-week swing trader. This indicator could help you catch some of these important turning points. And perhaps if you use it in conjunction with a bullish reversal candlestick or combination of candlesticks or bars, for example, a bullish reversal bar or an outside bar, that kind of thing. So if you've got a combination of a price pattern and the oscillator, that can give you some important evidence that the market wants to stop moving in its direction and maybe reverse for a few bars. And those few bars can give you a profitable opportunity. Okay, just looking a bit more at the dollar Canada one here, we can see some very good turning points here. This one here caught the bottom in early 2017, swung from oversold on the stochastic all the way up to overbought, where the market topped out. Oscillator topped out above the 80 level. Stochastics uses 20 and 80 for its natural overbought and oversold levels. So the market topped out and it gave you this really powerful swing, which lasted for several months, and some very important turning points here. The last one early in this year, 2020, the stochastic based out just below the 20 level, oversold, gave you the buy signal, and we saw a powerful rally from just below 130 up to 146, 147. So some pretty good signals there on the weekly chart using stochastics as a timing mechanism. Okay, so as with all indicators and patterns, anything to do with technical analysis, we have to throw in a bit of a disclaimer here and mention that the oscillators, as do the other tools, has certain limitations. So that's the thing. At the end of the day, if the market's in a trend, then the overbought level, as I say, they shift from fixed levels to slightly higher levels. So if the market's in an uptrend, the market will be topping out at slightly higher levels. So if the market breaks into new trend highs, the oscillator breaks above the overbought level, for example. If the market's actually in a trend, it will continue going. So you may get too early entry into a counter trend move. So it's good to know that there are certain limitations of oscillators. So as I say, oscillators work best in non-trending or range-bound markets. And when you get this kind of trend, this chop action, as I've shown you some of these examples before, the peaks and troughs in the oscillator will tend to coincide with peaks and troughs in the market. And that's exactly what you want. That's what you want them to do. So when you get into overbought or oversold, you are looking for the market to reverse and to give you a good opportunity for a counter trend trade, a mean reversion trade. That's what you're looking for. So they will give you, in a range environment, the oscillator will give you a good indication of whether the market is indeed too high or too low. But as I say, when the market is in a trending phase, and this doesn't happen that often, I would say that the market is in chop phase slightly more than it is in trend phase. But when the market is in trend phase, the oscillator will tend to perform a bit poorly because what you're doing is you're using an overbought level to fight against the trend. And that's never a good idea when the trend is in full swing. So that's why, just going back a few slides, that I refer to oscillators as a derivative tool, something that can help you. So it's not the main, an oscillator should never be your main tool. So number one, determine whether the market's in a trend or not. If it is, then use the oscillator, use the higher or lower levels that correspond with trend extremes. If the market's in a chop phase, then obviously use the normal overbought and oversold levels. What happens, just going back to the limitation, what happens is when the market's in a trend phase that not only do the levels of overbought and oversold shift in the direction of the trend, the oscillator tends to stay in overbought or oversold region for quite a long period. So let's say, for example, the market breaks into new low ground and the oscillator breaks below, say, 30, if you're looking at the RSI, and you think, okay, the market's oversold, I'm going to buy it. But what can happen, obviously, is if the trend is really strong, the market will continue to trend lower, and the oscillator can just bump around 20, 25, 30, 25, 20, whatever, and stay in the oversold region for a long period of time before eventually, when the market does turn, the oscillator will swing higher and then you'll get your signal. But all the while, you've been losing money by fighting against the trend. So a certain degree of caution has to be employed when the market is in a trending phase. Okay, so just to emphasize this point I was talking about here about the oscillators. So when the oscillators have fixed limits, for example, the RSI or the stochastic, they will have limits, for example, between 0 and 100. So what happens is the price in a downtrend, the price is trending lower, the green line, and the oscillator to a large extent goes along with the price. But eventually the oscillator will get towards this 0 line, it will become oversold, but it can't go below 0. That's the point about the fixed limit oscillator. Many of them cannot go below 0, which means that as the market gets close to 0, it will give you almost like a fake reading that the market is oversold because the trend is continuing to go down and the oscillator is just bumping along the bottom, as I say, between 0 and maybe 20 or 25 or 30. And then ultimately, when the price does turn, the oscillator will fly. And that will give you your typical standard buy signal. So for a no-limit oscillator, which I prefer, things like a rate of change and momentum, what we have is the price in a downtrend. It will continue to trend lower. The green line is trending lower. And then the oscillator can go below the 0 line. That's the point. So these there will be oscillators which can swing between, well, an unlimited amount plus and an unlimited amount to the downside, minus. And then eventually, when the market does base out, the oscillator will give you a natural reading for the oscillator. Okay, let's talk specifically now about momentum, which is quite a basic oscillator which doesn't have any upper or lower boundary. So momentum measures the velocity of price changes. It just simply compares the closing price to the price so many bars ago. A 10-day momentum is the closing price minus the closing price of 10 days ago. And this is plotted around the zero line, a bit like I just showed you with the no-limit oscillators. So there are no artificial upper or lower boundaries to the oscillator. So to determine whether the oscillator is in overbought or oversold territory, the idea would be to use visual inspection to check whether that is indeed the case. Also, one should be looking for divergences with the price for potential turning points. As with all indicators, the shorter the length of the indicator, the more sensitive it is. So for example, if we're looking at a 5-period momentum indicator and we're comparing it to a 20-period momentum indicator, the 5-period momentum indicator will be moving much faster and will be having much wilder amplitudes. So the oscillator will be quite jerky, whereas the longer one will be very smooth. And as I say, crossing above the zero line or below the zero line can give you an indication of the trend as well. Okay, so let's take a look at the momentum oscillator with a few charts. So first one is dollar-yen daily, and you can see that this is going back 2016 through to the start of this year, so quite a long period. You can see that for the most part, dollar-yen has been stuck in a bit of a range. It hasn't really had a major trend up or down for this whole period, which is ideal for the oscillator. That's the whole point of using the oscillator and making the most of it in a non-trending situation. So looking at the momentum oscillator, the 20-period momentum oscillator, which are plotted below the price, you can see that for the most part, the momentum oscillator goes between -5 yen, dollar-yen, and +5. So when the oscillator goes towards +5, it has been a fairly good indication that the market is apt to reverse and to turn lower. And the same thing on the downside over this period. As the market has come down, the momentum oscillator has come down towards -5 yen. That has been a good place to think about buying dollar-yen for a swing higher, with either back towards the middle of the range or either looking for a return to the overbought region. Next one, this is dollar Canada. This goes back to 2018 to early 2020. As with dollar-yen, for the most part, you can see it was in a trading range. And then towards the first couple of years, Q1, that's when volatility exploded in most of the markets and dollar Canada started to trend higher. But prior to that, we could see that dollar Canada, just using the 20-period momentum, basically chopped and oscillated between -200 pips or so and +200, 250 pips or so. So again, as with dollar-yen, as the market approached those thresholds with the blue lines on the charts, that gave you an indication that perhaps the market had gone too far, too fast, and was ready for at least a short-term pullback to mean revert. Then we got the explosion high with the trend, the big volatility explosion, and that saw the momentum indicator really ramp up to the upside. But once the volatility kind of came out of the market, interestingly enough, it came back into the normal range and found support again around this -200 odd, 250 odd pips. Another example here, this is cable on the weekly chart. So these things actually do work on various time frame charts. This one obviously has been in a bit more of a downtrend and more of a trend than the previous two examples, but also quite a large trading range since late 2016. So what we have with cable here is a rate of change, 20-period rate of change, which for the most part has been oscillating between minus 140 odd pips to the downside and perhaps 100 pips or so, or 10 big figures to the upside, 15 big figures and 10 big figures to the up and the downside. So we've got some natural areas of support and resistance. This latest dip on cable based out at the lower threshold. Moving on to a much shorter time frame now, we have euro dollar on an hourly chart. So we've got a sort of a broad-based downtrend, but not an aggressive one at that, kind of a begrudging, choppy downtrend. So what we've got using again the 20-period rate of change is euro dollar trending lower, but for the most part, levels of minus 80 pips and plus 80 pips are or have contained a lot of these moves over this multi-week, multi-month period. So if you are perhaps a day trader, you're looking for maybe 50 pips or something, then this kind of oscillator can help you attain that kind of move, or at least give you a framework to look for that kind of move on an intraday basis. Okay. So that's the momentum indicator. Now we move on to the rate of change, which is very similar. It's a very similar indicator to momentum in that there are no upper and lower boundaries. But what we're doing, instead of measuring in pure price terms the rate of change, we're measuring it in percentage terms. So the rate of change is simply the close minus the close n bars ago, divided by the close n bars ago, multiplied by 100. So we're looking for basically a percentage movement. Where are we in relation to the price n bars ago on a percentage basis? So a 20-week rate of change will simply be the close minus the close 20 weeks ago, divided by the close 20 weeks ago, multiplied by 100. So this is plotted around a zero line, and there's no artificial upper and lower boundaries. As with momentum, when the market is in a trend, it won't kind of flatten out just because the oscillator has got to a certain threshold. So as with momentum, the overbought and oversold extremes should be picked out by visual inspection. So as before, what we'd be looking to do is check out the chart, ask ourselves, where historically has the rate of change topped out or based out for this particular market? Now, different markets will have different thresholds, depending on how volatile they are. So obviously, it's good to know your market. So again, with the rate of change, we should be looking for not only levels of overbought and oversold, but also for divergences with the price, because they can give us an indication that a given move has run out of steam and is ready for perhaps a turn in trend. So we're looking for divergence between the price and the rate of change to give us a potential trend reversal signal. So as with all other indicators, the shorter lengths are more sensitive. So a 5-day rate of change will be much more sensitive than, say, a 30-day rate of change, and will produce many more oscillations and will move much quicker, and the amplitudes will be much wider too. Again, as with momentum, the crossing of the neutral level, the zero line, can also be used as a trend indicator. Okay, so let's see a few examples of rate of change. So first one is euro yen, daily chart of euro yen. And what we've got there, just looking at the chart itself, you can see pretty much a downtrend, although the corrections against the downtrend have been quite large, I would say. So lots of overlaps. So effectively a range-bound market, but with slightly lower highs and lower lows. So it's good to get a handle on the kind of environment that you're trading in before you decide to use the oscillator. So what we've got below that is the 14-day rate of change. And for the most part, we can see that it bases out, or has based out, around the -2% level, and topped out not too far beyond the +2% level. So again, if you're looking for these kind of multi-day swings, once we get into that +2% region, then we're looking for signs perhaps on an intraday chart, or maybe some price pattern like a candlestick, a bearish engulfing, or some kind of combination of 1, 2, or 3 bars or candles to give us a sell signal in line with an overbought reading on the rate of change. Some of these peaks and troughs here were actually caught quite nicely on this rate of change indicator. Another example, this is the euro against the Norwegian krone, euro NOK. And again, a bit like euro yen, but perhaps turned upside down, is that we have a slightly sloping uptrend over this whole period, although the pullbacks have been very, very deep, which makes it look a little bit like a range-bound market, but with slightly higher highs and higher lows. Now, because it's not on a very aggressive trend over this period, the momentum oscillators can work quite well. So in this case, what we've got is the 20-period rate of change, and the -3% and +3% levels on the rate of change have actually been fairly good indicators that the euro NOK has got into an area where it could potentially reverse. So yeah, some of these peaks and troughs on euro NOK have coincided quite nicely, particularly this one in early 2020 this year, where the market had this pullback, based out, started to go higher, and then the oscillator started to make like a W bottom and then go higher from the oversold region. And then we saw a vertical move back up in line with the overall trend. Okay, this one is dollar Mexican peso, and this again uses a 20-period rate of change. This is on a monthly chart this time. So just to give you an idea that these things can also work on much longer term charts as well as the shorter term charts too. So this one is in much more of a defined uptrend. So as I say, the levels in oscillators, when you're in a defined uptrend or a downtrend, the levels on the oscillator tend to shift so that we've got a bit of a skew in favor of the trend. So in this case, the trend has been up. And when the market tops out, it's basically coincided with +40% on dollar MEX. So basically +40%, market's overbought, comes back to slightly below the 0 line. That's the oversold level. Don't forget, we're using visual inspection for these oscillators that do not have fixed extremes, which I call artificial extremes, Rsi Stochastics, for example. So when we get the pullback, the market, as it comes below the 0 line on this 20-month rate of change, the market is apt to reverse to the upside and start to resume its trend. So if you're a swing trader looking for moves in the direction of the trend, this is not a bad oscillator to have in your toolkit. Okay, so now we're going to move on to some of these indicators, oscillators, which do have artificial levels. As I say, I'm not a massive fan of them, but I do want to give you the complete picture, because I think you need to see the complete picture. What works for one person may not work for another person, and vice versa. So to give you the complete picture, let's talk about some of the indicators like RSI and stochastics. So RSI was developed by J. Wells Wilder Jr., and it's one of the most famous momentum indicators that technicians use. So it's used to measure the magnitude of recent price changes, and it gives you an idea as to whether the market is overbought or oversold. It's plotted between 0 and 100, with, as I say before, 30 being the oversold level and 70 being the overbought level. The standard setting is 14 period, but many technicians also like to use the 9 period. It's quite common, and that gives you many more signals than perhaps earlier entry into a move. So in an uptrend, just going on the principle of shifting overbought and oversold levels, the RSI will typically base between 40 and 50 in an uptrend. So in other words, instead of basing down at 30 or below, it'll base between 40 and 50. And in a downtrend, it typically peaks, tops out, makes its overbought reading between 50 and 60 rather than 70, as is the standard default setting. With RSI divergence is also an important feature. So what you're looking for is when the price makes a new high for the trend and the RSI does not make a new high for a trend, that is a warning to the bulls that the market move has started to lose momentum and is apt for a turn. Same thing on the downside. When the market is trending lower and the RSI does not follow the market to new trend lows, that gives you an indication that the decline is on its maybe on its last legs and ready for a turn. Okay, so let's take a look at a few examples of the RSI in action alongside the price. So first one is Euro-Yen daily. Initially, we start off with a downtrend. The market is trending zigzagging lower, and the first swing goes to oversold. It bounces back up again, and then we get this big extreme move down where it's ringed again to a very oversold level, and the market bases out, nice reversal bar, and starts to go higher on a multi-day, multi-week basis. The uptrend then tops out. RSI tops out above 70. We get a toppy pattern on the chart which has been ringed below 132, and then the market starts to trend lower. Then the market bases out eventually just ahead of the previous low. RSI goes into oversold territory, bases out, and then sees a very powerful rally, which tops out in the overbought region on the RSI. We get a pullback, market breaks up to overbought, tops out, and then the swing back below into the below 70 into the neutral zone gives us the sell signal that we need for the top of this market. On the way down, there's a fake signal there where the market breaks into oversold, goes sideways for a bit rather than down, then eventually breaks down, and then we get this divergent push to new lows for the price, which is followed by a multi-day push to the upside. Another example here, this is cable daily. So the chart, it starts off falling and basing out just, I think, below the 122 level. And then this is an oversold level on the RSI. The market swings higher, forms a base pattern. The RSI goes back from oversold into neutral, and then that's the bottom of the market for a long, long time. So the market starts to trend higher. The second push higher sees a big spike higher, a momentum peak, sideways. And then as the market kind of grinds to new highs, we see this divergence, which I've labeled there in orange. So you can see the market is pushing to new highs. The oscillator, the RSI, is not making new highs. And that eventually gives you the turn for the market to see this little downtrend here. The downtrend finally bases out, goes into oversold level on the RSI. We get a bounce, we get a final push to a new low, which is not confirmed by the RSI. And then that calls the bottom of that particular swing. And then we go back to the uptrend that we had previously. And a few more turns along the way. The most important one being the last buy signal, which comes, I think, late August, before the market made its base and then saw an aggressive move from 127.50 or so up to 136. Another example, this is Euro-Dollar 2-hourly chart, 120-minute. This one starts off, it's trending lower, forms a bullish divergence with the RSI, 14-period RSI. The orange line marks the divergence where the price swings low, marks its momentum low, bounces, makes a new low, a marginal new low, but the oscillator doesn't confirm it, and then you get the reversal in the price. That's what you're looking for. and then the RSI swings higher, then a big powerful move to the upside, tops out, slightly in overbought territory, we get the correction, goes again, and this is where the big divergence comes as the market pushes to new highs for the trend. We had a 1, 2, 3 stabs higher for the trend, but the second and third push to new highs were not confirmed by the RSI, and eventually we get this topping situation where the market makes a powerful aggressive move to the downside. So then the market breaks down. First shot at oversold, we get a bounce, then the market breaks down, trends lower, we get the divergence, and then the market stabilizes. Okay, that's the RSI. Now we're going to talk a little bit about stochastics. So stochastics, another very popular oscillator that technicians use. This indicator was developed by George Lane in the 1950s, been around a while. Again, it's a momentum indicator, but it's a little bit different because a bit different from most of them, because what it does is it compares the closing price to its recent range. So it's not comparing the price to the price N bars ago, it's looking at the price range. So it's saying, okay, between 0 and 100% of the range, where is the current closing price? So the closer the closer the market gets towards the top of its N bar range in terms of percent, the more overbought the market is said to be. Again, as with RSI, it's plotted between 0 and 100, and it represents the percentage of the N bar range. So with stochastics, oversold readings are 20 and below, and overbought readings are 80 and above. So slightly higher than the RSI readings. And also, because the stochastic is a bit more volatile than many of the other oscillators, what George Lane did was he slowed it down a little bit by introducing averages, moving averages of the raw stochastic number. So what you get is you get 1, 2, and sometimes 3 different stochastic readings. And they're just simply moving averages of the derivatives of the first stochastic reading. So you get what they call fast and slow stochastics. So a fast period is, you'll get a 14 period with a 3 period moving average, makes it a slow stochastic, and a 3 period moving average of the slow stochastic gives you the slow D. So you basically, what you've got is K and percentage K and percentage D, and you've got fast K, slow K, and slow D like that. So it's basically, you start off with the 14 period range, you're looking at where the price is in relation to it, and that will give you your percentage number, and then you're just deciding how many moving average occurrences do you want to do to slow the thing down. So as with the other oscillators, the typical use is to look for oversold and overbought extremes. We've got the demarcation of 20 and 80, and also to look for divergence with price. Also, we have an additional filter here if you're using them as signals or inputs into systems, or to give you a market timing device. And this would be when the stochastic crosses its moving average. So for example, when percentage K crosses above or below percentage D, then that will give us a buy or sell signal. And if it's from an extreme zone into the neutral zone, all the better still. Also, we're looking for just a raw crossing above 20 or below 80 to give us a sell or a buy signal. Okay, so let's see a few examples of stochastics in action. And what I've done here is I've labeled a lot of the crossovers between the fast and the slow stochastic as indicated there to show you where they coincide a little bit with some of the highs and lows on a chart. So first example is dollar yen daily, and we can see that initially the market rallies, and then you get this kind of what they call stochastic crawl, where the indicator stays overbought for a long period of time. If you recall, I mentioned that's what happens during a trending phase. When the market goes into trend, the oscillator will stay overbought or oversold for a long period of time. So it can be very premature to sell a market just because the oscillator has broken into overbought territory. Better to wait for it to top out with the price action and maybe to come back below back into the neutral zone. So yeah, as you can see, a number of crossovers here, which give you some good indications for maybe 5 or 6 day price swings, and that's essentially what we're looking for. So this one, for example, the market's been trending low for several days. We get a bullish reversal bar or candlestick, and then the stochastic crosses from the below zero or below the 20 oversold level back above it, and the K crosses above the D. So you've got another kind of filter there to say this is a momentum buy signal. On the way down, you've got a sell signal there, a good buy there, and a nice sell. Before we got this extreme gyrations in volatility, we had a couple of good signals here. Okay, euro dollar daily, another example. So euro dollar daily, it was kind of in a range, chopping around here, and then we got the move into oversold on the stochastic. The market made a powerful rally, nice correction the next day, starts to trend higher, and as it does that, the oscillator swings from oversold into the neutral zone, and K crosses above D, and we've got ourselves a nice little buy setup from a momentum perspective, and that gives you a good maybe 3-4 week move to the upside, which is not to be sneezed at. Market goes into hard trend mode. We see some sideways action in the oscillator, stuck in overbought, stochastic crawl to the upside, and then we get this little push to the upside, and the market tops out amid a kind of a cross to the downside on the stochastic into the neutral zone, and the market comes down for a couple of weeks. Base is out, stochastic is in oversold territory, gives you a crossover here, and then followed by a cross back above the sell threshold level, or the buy threshold level, sorry, and then that gives you the indication that the market wants to go higher. A couple of important peaks and troughs here, again caught by the stochastic oscillator. Okay, just bringing it down to a shorter time frame, cable 30-minute. Again, the market starts off quite strong. It's in overbought territory, but then we get the crossover from overbought into neutral, and then the market tops out, and then we get a nice multi-bar swing to the downside. Base is out under the oversold level, swings higher, nice rally. So these are good for maybe, again, 50 pips up and down, that kind of thing, if you're that kind of trader. Market tops out in overbought territory, then starts to trend lower. The oscillator turns here, so you've got nice early warning of the impending decline, and then the market just starts to chop to trend lower. As the market actually gets into trend mode, you'll notice on this particular bounce, the oscillator tops out just below 50. So it can give you an indication that you're getting into some aggressive trend mode. Okay, now we're going to look at another popular indicator called MACD, or Moving Average Convergence Divergence. So here's MACD. It's basically a trend following momentum indicator. So what it does, it's trend following in that it compares two exponential moving averages, and it basically works out the difference between those two moving averages, and that's the MACD line. And then you do a moving average of the MACD line, and that gives you what they call the signal line. So when the MACD line crosses below the signal line and vice versa, you have signals. So it's so basically it uses the exponential moving average of the MACD line for the buy and sell signals. That's the signal line. So it's basically a histogram to show the difference between the MACD and the signal line. So default setting for MACD is basically the 12 and the 26 period exponential moving average, and the signal line is just a 5 period moving average of that. So MACD, how do you want to use the MACD? Well, when the MACD crosses above and below the signal line, obviously that gives you a signal, a buy or sell signal. But also it's good to look at, as with all of these oscillators, to look for divergences with the price. So there's actually MACD is actually quite good because it does a number of different things. It's not just your standard oscillator that just oscillates between two levels or two extremes. There's quite a bit to it, so it's definitely worth a little bit of study, I would say. So yeah, looking for divergences with the price, again, typical oscillator behavior. Okay, so now we're going to check out some examples of price with MACD. First one is sterling dollar cable. This is a daily chart. And the first thing to note on the chart, obviously, it's in quite a pronounced downtrend. And that downtrend is kind of flagged up when MACD crosses below the zero line. So if you recall, I mentioned that we can use MACD as a trend indicator as well as an overbought, oversold oscillator. So as MACD crosses below the zero, that gives you the indication that the trend is down, and indeed the trend was down. It started to trend lower. So now looking at the MACD line, you can see what happens here is it bases out. It's in a downtrend, but it tends to base out around this this minus 150, 140, 150 level on the line. Also, the difference between the two, the MACD and the signal line, you can see that this actually has got some pretty good barriers too. So this tends to be overbought and oversold around the minus 400 level on the way down and plus 250 on the way up. So you can see that as the market is in a downtrend, obviously the lower level of this this histogram is lower than the upper level because we're in a downtrend. It's that typical oscillator behavior. But if we're looking for the market to top out, the market has traditionally topped out at plus 240, 250 on the MACD line. Another example, this is Euro-Yen hourly. This one is in a downtrend, starts off quite aggressive, but then we start to see a bit of a choppy downtrend. And again, you can see that the downtrend is flagged up when the MACD line goes below zero here. And it stays below zero for the most part during this downtrend, except perhaps for this last bit. So the MACD line is below zero. It's finding support around roughly the same kind of levels on the way down. So that gives you a kind of a oversold extreme. And also the histogram is finding support again at roughly the same kind of levels here. So minus 500, minus 600 on the MACD histogram, and on the upside, plus 6, plus 700 on the histogram. So you've got some natural levels to look for the market to top out, and I've ringed a few toppy patterns here that coincide with the blue line on the MACD histogram. Moving across to another example, this is Australian dollar, Aussie dollar daily, and again plotted with the MACD. What you can see here is a downtrend, but again a very choppy downtrend. So the market is making lower highs and lower lows, but the bounces are actually quite strong. Looking at the MACD, because it's more of a kind of range-bound market, in other words, not an aggressive downtrend, we're seeing lots of penetrations of the zero line on the MACD itself. But so that gives you some indication that the market is in a kind of a choppy kind of phase, despite making lower highs and lower lows. But there is a clear overbought and oversold region here for visual inspection. Because the market is in a downtrend, obviously the overbought level is lower than the oversold level is on the way down. The overbought, the bounces tend to coincide with levels of plus 265, and the oversold levels tend to coincide with minus 500 on the way down. So you've got a natural area to look for the market to top out or base out within the context of this downtrend. Okay, so now moving on to one of my favorite indicators, which is the average true range. Now, the average true range also was developed by J. Wells Wilder, the RSI man, but this is actually a measure of the market's volatility rather than its momentum. So the true range it uses the true range of the market, and it calculates an average of this true range over a certain period. And the idea, as I say, is to gauge the market's volatility. So the true range is the highest of the previous close and the current bar's high, and the lowest of the previous bar's close and the current bar's low. So what it does is it takes into account, it looks at the current bar, the high and the low, that's the current bar's range, but it also takes into account the previous bar's close for markets which gap. So if you see a gap from the previous bar which doesn't overlap with the previous bar's close, then you include the previous bar's close to give you a larger range. So the standard setting for ATR is 14 period, but also the 20 period ATR is also quite common. And the theory is that as the market gets more volatile and daily ranges, for example, expand, the noise levels increase. So if the average trading range or the average true range for a given market is 200 pips, a 50 pip move isn't that significant because it's only 25% of the ATR. Whereas if the ATR is only 50 pips, a 50 pip move is highly significant because it's 100% of the ATR. So we need to get a handle on how volatile a market is for when we set our stops, because obviously if we're setting our stop if we're setting our stop at a level which is too close to the market in terms of its volatility, we're going to get taken out far too often. So it's good to use ATR as an input into the stop sizes to help reduce the whipsaws and reduce overall risk. So just a quick graphical representation of the ATR. So the true range in this example here is, so the difference between the current bar's high and low is the normal daily range, or the normal range for the bar. But what we're doing with the true range is we're including the previous bar's close. So the orange bar is the true range of this particular day. Next one, same again. The current day's range is the difference between the high and the low here. But if we get a gap up above the previous bar's close, we need to include the previous bar's close within the true range. So again, the orange bar gives us the true range for this particular market. Okay, so let's see what this average true range is all about. So the chart I'm showing you here is a daily chart of euro dollar. It goes back to start of 2018 into early 2020, and you can see it's in a downtrend, but in a very choppy downtrend. Now, for the most part, what you can see is the ATR is actually trending lower with the price. This is I think quite by accident, really. The fact that the ATR is trending down with the price, it's not that isn't the usual situation. But in fact, what it's doing is, because the daily ranges are getting smaller and smaller, the average true range is getting smaller and smaller. So what's happening is it's actually trending lower because the amplitude of the swings on these days up until this point here was becoming smaller and smaller. So if you had breakout systems, as I did in 2019, you weren't having the same success as you had in prior years because breakouts weren't following through, and more, I'd say, more mean reversion systems, oscillator systems would have been better to use. So we have a situation where volatility last year and for some of this year was very low. For example, euro dollar for much of the previous few years, the average true range was above 80 pips or 70 pips. But for the recent past, before the explosion in volatility, it went down to 40 or 45 pips. So you can see that having a handle on volatility is quite a good idea. So what happened recently, obviously, with the corona influence and the stock market gyrations, everything got volatile. We had a massive explosion in volatility, and we saw this big explosion in euro dollar volatility here from low to high. And you can see that the average true range went up briefly to above 180 pips. So it was a bit like Back to the Future. We were going back to previous years before this decline in volatility that we've seen. Another example here, just to show you the same phenomenon, but this is going back to the previous market explosion in volatility during the great financial crisis in 2008, 2009. Cable, for the most part, in the years prior, was stuck in a range, average true range between 100 and 200 pips. So for the most part, you knew that cable was going to trade on average 100 to 200 pips on a daily basis during this period. And the blue lines pretty much contained it apart from that small dip there. And then eventually we got the crisis start to hit in 2008, and then volatility exploded, and you can see what happened. The average daily range, true range, went up to above 500 pips. So if you're trading with your 50 pip stop during this period, you might be doing okay. But if you use that same 50 pip stop during this period, you're going to be taken out by noise, and it's very dangerous to do this. So it's good to have a handle on volatility. So just to show you how I would use ATR as an input into my sizes. So let's see an example. Let's say a trader uses a 50 pip stop on each one lot trade to control the risk. So the 50 pip stop could be good enough to avoid the noise if the ATR is 100 pips or below. But if the ATR doubles, and that reflects an increase in volatility, then the so-called noise levels rise. And that makes it easier for that stop loss to get hit by random noise. So my contention is what the trader should do is actually double the size of the stop in pips from, say, 50 to 100. So if the ATR goes from 50 to 100, i.e. it doubles, then you should double the size of the stop. But that has the downside effect of actually doubling your risk. So the way to counter this is to reduce the lot size by the same factor to bring the monetary risk back into line. So let's say, for example, the ATR goes up to 200 and the stop is 100 pips. Then the trade size has to go down from one lot to 0.5 lots. So that way you are equalizing, the dollar or the monetary risk on the trade. Okay, so now what I want to do is just have a quick run through of some of these markets, and then we'll wrap up the session. Let me just flip across to the screen. We will share our screen like so. Share, and we go to our CFI trading platform just to show you a few examples and what I think is may well be happening based on some of these indicators. So first thing is I'm looking at some monthly charts here to get a real handle on this stuff. This is Aussie dollar monthly, and you can see that Aussie dollar monthly has been in a massive downtrend up until fairly recently, when the market went down to this new extreme low, and there was a large divergence on the 20-month rate of change. And since then, we saw a big spike lower, long lower shadow, and the market started to trend higher on a monthly basis. So this to me looks like a nice buy signal based on momentum divergence on the Aussie dollar. Next example, this is crude, West Texas. Nothing really to write home about on the oscillator, except that it got into quite an extreme oversold condition, obviously, as the market did get hammered on the way down to the recent low. We're bouncing back up from there. I think it depends really. Should we get back above the broken support level and then stay above it, then maybe we're into a nice up phase. But I'd be a little bit wary on this one. If we top out and start to break lower, it could well give you another push down. But we'll have to monitor that one on a daily or weekly basis. Dollar yen monthly. Now this one, the indicator doesn't really give you a whole lot of guidance, I would say, in terms of overbought, oversold, or divergence, because the market's been in this chop. There's not really been a whole lot of clues, except maybe this long lower shadow here on the candle, which wasn't really followed down, but it's not a major divergence by any stretch of the imagination. Major divergence actually came on this market back here when it made this major low back in 2011 or so. when the momentum low was there and the price low was here. So that was that's what a real divergence looks like. Euro dollar. Now this one's interesting in the fact that we've seen a minor divergence. So in other words, we saw a push to a new low, then base out, and then it starts to sort of trend a little bit higher, and we're heading towards the zero line. So perhaps we cross above the zero line on the monthly basis, maybe coinciding with the break above this 115 level, and we see a big push higher on euro dollar. This is S&P 500. The major thing I would say to write home about on this one is obviously we saw the big push last year to the all-time high, and then obviously the corona-related crash or correction, depending on which way you see it. So what happened was we had the push to new highs. We had the small divergence here in 2018-19, and then the momentum low there, push to new highs, which wasn't confirmed, and then the top out. So you see this massive divergence here, then this big blowout here, and then we've based and we've gone a little bit higher. So I guess the question would be whether we're going to be pushing up, making a slight new high, and then we get the real divergence again, or whether this is a major extreme low and we're part of a new upcycle for a longer term. But I think we need to monitor the price action for that one. Dow Jones, obviously a similar situation. The momentum peak came here, and then we saw a couple of pushes to new highs, followed by the final blowout there. Now we've gone higher, and again, we need to see what we've just crossed above the zero line, and we're crossing above it. We need to see how we do, because we're getting a bit of an upper shadow on the monthly candle. Gold is looking quite positive. This one is breaking higher. There's no divergence on this particular swing, so this is a nice, healthy looking rally, in my opinion. So we're basically seeing new highs for the price, new highs for the indicator, and this one looks to be quite buoyant, in my opinion. Okay, so that pretty much wraps it up. I'm just going to get back to end sharing. So thank you all for listening. I'm just going to open up the floor for some questions to see whether there are any questions. Just 1 second. Yeah, so if there are any questions, please feel free to fire them across just over the next few seconds. I'll wait for a question. If not, it appears not. So okay, so what I'll do is I'll close it here. Thank you all for attending, and I look forward to seeing you next week for my presentation on Elliott Wave and Fibonacci. Thanks for attending, and have a good one.